There are three things about your bank deposits that your bank, your financial advisor, and the mainstream financial media have either never told you or told you so incompletely that the incomplete version is functionally the same as not telling you at all. The first thing is that the federal law designed to prevent taxpayer bailouts of failing banks, the Dodd-Frank Act, contains a mechanism called the Orderly Liquidation Authority that forces shareholders and creditors of a failing systemically important financial institution to absorb losses through what is technically called a bail-in, meaning a conversion of certain debt claims into equity rather than a cash payout. The second thing is that approximately $7.5 trillion of deposits sitting in American bank accounts right now, as of the most recent data available from Bauer Financial's analysis of FDIC call reports through June 30, 2025, are formally uninsured, not partially insured, not mostly insured, formally, legally, officially uninsured above the $250,000 per ownership category per institution limit that the FDIC has been clear about since 1933. That $7.5 trillion represents approximately 45% of all domestic deposits in the American banking system, according to Bank Policy Institute analysis of FDIC data. And the third thing, the one that connects the first two into a single coherent picture, is what actually happened in March 2023 when Silicon Valley Bank failed. Because what happened was not what the Dodd-Frank Act prescribed. What happened was that the Treasury Secretary, the FDIC, and the Federal Reserve invoked an emergency systemic risk exception, bypassed the Orderly Liquidation Authority that Dodd-Frank had created specifically for this type of event, used the Deposit Insurance Fund to make all depositors whole, including the uninsured ones, and then assessed a special fee on banks to partially replenish the fund. A law professor at George Washington University School of Law named Arthur Wilmarth published an analysis in American Banker in 2023 stating plainly that the SVB and Signature bailouts broke Dodd-Frank's promises. The Orderly Liquidation Fund that was supposed to pay for the resolution under Title II of Dodd-Frank currently has a zero balance. It has always had a zero balance because, unlike the Deposit Insurance Fund, which is pre-funded through ongoing bank assessments, the Orderly Liquidation Fund is funded only after a failure. The Treasury lends the FDIC money, and then the FDIC assesses surviving institutions, which means that in the exact moment when a large, complex financial institution is failing and the systemic risk to the economy is highest, the Orderly Liquidation Fund has no money in it. None. And the resolution of the crisis depends on a Treasury lending decision made in a compressed time frame under maximum political and financial pressure. That is the complete picture of deposit protection in America in April 2026. Not the simple picture of $250,000 per account fully insured by the government. The complete picture. And you need the complete picture because the banking stress data that this channel has been documenting across the last several videos, the FHA delinquency signal at 11.52%, the first bank failure of 2026, already recorded, the New York Fed's largest single-day repo injection in over 2 decades, the FDIC's own deposit insurance fund at a 1.42% reserve ratio, and the Federal Reserve Board's published research confirming that in a stagflation funding shock scenario, bank profitability and capital ratios are materially reduced for a significant subset of institutions is not abstract. It is a trajectory. And the trajectory is heading toward an environment in which the adequacy of deposit protection will be tested for the first time since March 2023. Let me give you the full picture of each of the 3 layers and then show you precisely what they mean for the money in your specific bank account. Let me start with what the Dodd-Frank bail-in mechanism actually is, because it is the most technically misunderstood piece of financial legislation affecting ordinary Americans, and because the misunderstanding is not accidental. The term bail-in has been weaponized in fringe financial content to mean things it does not legally mean, which has produced the opposite of clarity. When people hear bail-in, they think it means the government taking their savings account to recapitalize a failing bank. That is not what the Orderly Liquidation Authority does. Let me be specific about what it does do. Title II of the Dodd-Frank Act creates a mechanism for the FDIC to be appointed as receiver of a failing systemically important financial company, meaning a large, complex financial institution whose failure would pose a risk to the financial stability of the United States. This category includes the largest bank holding companies, their non-bank subsidiaries, broker-dealers, and other designated systemically important financial institutions. When the FDIC is appointed as receiver under Title II, it takes control of the assets, obligations, and operations of the failing company. The claims of shareholders are wiped out entirely. Shareholders take the first loss. Then unsecured creditors, meaning the holders of the holding company's bonds and other non-deposit debt instruments, take losses through the bail-in mechanism, meaning their debt claims are converted into equity in a new bridge company that continues operating while the resolution is completed. Insured depositors at the bank subsidiary are fully protected by the FDIC, This is specified in the law. The FDIC's first responsibility is to protect depositors who are insured up to $250,000, according to the Brookings Institution's own analysis of the Dodd-Frank framework. Those insured depositors get their money immediately. The bail-in affects shareholders and unsecured creditors at the holding company level, not insured depositors at the bank subsidiary level. That distinction is the difference between the truth and the fear-mongering version of this story. And it is the distinction that makes the second layer, the uninsured deposit layer, so important to understand precisely. Because uninsured depositors are not insured depositors. They are creditors. And in a genuine Orderly Liquidation Authority resolution, they are not automatically protected the way insured depositors are. Their recovery depends on the assets available to the FDIC after the resolution process. In a disorderly resolution, in a liquidity crisis, in a scenario where the assets of the failing institution are worth significantly less than their face value, uninsured depositors may receive partial recovery. Not full recovery, partial. That is the bail-in trap for the holders of the $7.5 trillion in uninsured deposits currently sitting in American banks. Let me show you the four-stage pattern through which deposit protection failures have historically played out in American banking history, because the pattern is the key to understanding why the current moment is not a theoretical risk, but a documented trajectory. Stage 1 is the pre-crisis comfort. This is the period during which deposit insurance appears to be universal and complete. Banks appear healthy by standard regulatory metrics, and the distinction between insured and uninsured deposits is invisible in the daily financial experience of ordinary depositors and businesses. Every major banking crisis in American history has had a stage 1 that was invisible until it was not. Stage 2 is the stress accumulation. This is the period during which specific institutions develop vulnerabilities that are not visible in their publicly reported capital ratios or their standardized stress test results, but that are visible in the granular loan portfolio data, the unrealized securities losses, the deposit concentration patterns, and the commercial real estate exposure that this channel has documented across the last several videos. We are currently inside Stage 2. The FHA delinquency rate at 11.52% is Stage 2 data. The first bank failure of 2026 is Stage 2 data. The repo market stress signals, the October 31st and December 31st interventions are Stage 2 data. Stage 3 is the confidence shock. This is the event that converts invisible institutional vulnerability into visible depositor fear. It can be a single institution failure that triggers contagion, a geopolitical shock that dramatically worsens the economic outlook, a data release that reveals the vulnerability more clearly than the smooth surface suggested, or a combination of all three arriving simultaneously. In 2023, the confidence shock was the publication of SVB's bond sale and the rapid revelation of the scale of its unrealized securities losses. In the current cycle, the Iran war oil shock, the March CPI at 3.7%, the University of Michigan confidence reading at 47.6, and the ongoing repo market stress are all Stage 3 candidates. Not one of them has yet produced a Stage 3 confidence shock, but each of them has narrowed the margin between Stage 2 stress accumulation and Stage 3 activation. Stage 4 is the resolution crisis. This is when the confidence shock produces deposit outflows at a rate the institution cannot withstand. The FDIC is activated, and the specific question of whether uninsured depositors will be made whole or will receive partial recovery is answered by a combination of the institution's asset quality, the FDIC's fund balance, the Treasury's lending decision, and the political judgment of the Treasury Secretary about whether the institution qualifies for the systemic risk exception. It is not a mechanical process governed entirely by transparent rules. It is a judgment call made under maximum stress with maximum political pressure by human beings who may or may not make the same judgment that produced full depositor protection in March 2023. Let me prove this pattern with 3 historical examples that show precisely how deposit protection has worked in practice, as opposed to how it is described in the simplified version most Americans learn. The first example is the savings and loan crisis of the 1980s through 1990s. The Federal Savings and Loan Insurance Corporation, the FSLIC, was the deposit insurance mechanism for savings and loan institutions. It was separate from the FDIC. When the savings and loan crisis produced over 500 institutional failures across 15 years, the FSLIC was overwhelmed. By 1989, the FSLIC itself was insolvent, meaning it had paid out more in deposit insurance claims than its fund contained, and had borrowed more from the Treasury than it could repay from future assessments. Congress abolished it in 1989 and transferred its functions to the FDIC, which was also authorized to borrow from the Treasury to complete the resolutions. The total cost to taxpayers exceeded $160 billion. The lesson is not that depositors lost their savings in the savings and loan crisis. Most of them did not, because the FDIC and then the FDIC eventually honored all insured deposits. The lesson is that the deposit insurance fund itself can be overwhelmed by a large enough wave of institutional failures, and that the resolution of that overwhelm requires a political decision to use taxpayer funds, a Treasury borrowing authorization, and a multi-year process that produces delayed access to some funds and partial recovery on uninsured balances. Check. Verified. Undeniable. The second example is Cyprus in 2013, which is the most precisely documented case of what a bail-in event looks like when deposit protection is explicitly limited and depositors above the protection threshold absorb losses. In March 2013, the Cypriot government, facing a banking system insolvency that it could not resolve without European Union financial assistance, agreed to a resolution that imposed a one-time levy on all bank deposits above 100,000 euros. Uninsured depositors at the two largest Cypriot banks were required to convert approximately 47.5% of their excess deposits into equity in the restructured institutions. That is not a metaphor. That is 47.5 cents on every euro above 100,000 euros, gone. Businesses that kept their operating cash in Cypriot banks above the insurance threshold lost almost half of it. The insured depositors, those below 100,000 euros, were protected. The precedent that Cyprus established for the European Union's bank resolution framework, and that informed the development of the global bail-in standard for systemically important financial institutions, is that when the Deposit Protection Fund is insufficient to cover all depositor claims in a failing, systemically important institution, the depositors above the insurance threshold absorb losses before any public funds are used. The United States has not implemented the Cyprus precedent directly. The FDIC's systemic risk exception in 2023 demonstrated a different political judgment. But the legal framework under Dodd-Frank's Orderly Liquidation Authority is closer to the Cyprus model than to the SVB emergency resolution model. And the Orderly Liquidation Fund, which is the U.S. equivalent of the European Resolution Fund, has a zero balance. When the political judgment in a future crisis differs from the judgment made in March 2023, the legal framework that governs the outcome is the one in which uninsured depositors are creditors, not protected depositors. The third example is March 2023 itself, because it is the most recent and most directly instructive case, and because it is the example that most clearly demonstrates the gap between the legal framework as designed and the legal framework as applied under political pressure. And when SVB failed on Friday, March 10th, 2023, the FDIC had 2 business days to decide how to resolve it before markets opened Monday morning. The Orderly Liquidation Authority existed. The Orderly Liquidation Fund existed, but had a zero balance. The FDIC's Deposit Insurance Fund existed with a balance of approximately $128 billion at the time. The legal framework said that insured depositors would be protected, and uninsured depositors would become creditors of the failed institution waiting for recovery through the resolution process. Treasury Secretary Yellen, Federal Reserve Chair Powell, and FDIC Chair Grunberg made a different decision. They invoked the systemic risk exception, used the Deposit Insurance Fund to protect all depositors, including the uninsured ones, and resolved the institution outside the Orderly Liquidation Authority framework entirely. The reason they did not use the Orderly Liquidation Authority was made explicit in the analysis published afterward. The Orderly Liquidation Fund has a zero balance. Using it would have required borrowing from the Treasury, which would have made crystal clear that the bailout of uninsured depositors was placing taxpayers at risk. The systemic risk exception allowed the same outcome with less political visibility. A law professor published an analysis calling the SVB and signature resolutions a breach of Dodd-Frank's promises. He was right about the mechanism. And the point that matters for 2026 is this: the systemic risk exception is a discretionary decision made by the Treasury Secretary, the FDIC, and the Federal Reserve. It is not a legal entitlement. In March 2023, the decision was made to protect all depositors. In a future scenario involving a smaller institution, a less politically connected depositor base, a more constrained policy environment, or a Treasury Secretary with a different political judgment, that decision may not be made the same way. This is the moment I want to stop and speak directly to you. The 3 historical examples you just heard are not designed to frighten you. They are designed to give you the complete picture that your bank, your financial advisor, and the simplified mainstream financial coverage have never provided. If this channel is giving you that complete picture, please hit subscribe right now and turn on every notification. Because the protective actions that the 1929 protocol video in this series described are directly responsive to everything you have heard in this video. 3 practical actions before any crisis arrives. Let me now give you the specific current numbers that make this analysis urgent rather than academic. Here is the current data that defines the scale of the uninsured deposit exposure in the American banking system. Total estimated uninsured deposits in U.S. banks now exceed $7.5 trillion, according to Bauer Financial Analysis of FDIC call report data through June 30, 2025. That represents a 9.4% increase in the past year alone, more than twice the growth rate of total deposits. JP Morgan Chase alone reports $1.225 trillion in estimated uninsured deposits, the largest of any institution. 12 other large banks each report more than $100 billion in uninsured deposits. Across all reporting banks, approximately 45% of total domestic deposits are estimated to be uninsured, according to Bank Policy Institute analysis published in December 2023. That 45% figure applied to the approximately $17 trillion in total U.S. domestic bank deposits means that approximately $7.6 to $7.8 trillion in deposits currently has no FDIC protection above the $250,000 limit. The FDIC's Deposit Insurance Fund held $153.9 billion as of Q4 2025 at a reserve ratio of 1.42% of all insured deposits. That 1.42% compares to the FDIC's own long-run target of 2%, which the agency says is enough to withstand any future banking crises. At 1.42%, the fund is below its own target by more than $5 billion relative to the 2% level. And that fund, $153.9 billion, is the entire backstop for the insured portion of the American banking system. It covers the $250,000 insured limit for every depositor at every bank. In a scenario involving simultaneous failures at multiple mid-sized institutions of the type that the Federal Reserve Board's own stagflation funding shock research says is possible in the current environment, the capacity of the $153.9 billion fund is the binding constraint on how quickly and how completely insured depositor protection can be delivered. The math is not frightening for the typical household with a single checking account far below the insured limit. It is directly relevant for the small business owner with a payroll account at a single institution that routinely exceeds $250,000, for the real estate investor with equity returns sitting in a single bank account, for the retiree who received a lump sum pension distribution and has not yet structured it across multiple institutions and ownership categories, for the business that keeps 6 to 12 months of operating reserves in a single savings account. For every one of those people, the 7.5 trillion number is not an abstraction. It is the pool they are in, and the pool is $7.5 trillion deep with a $153.9 billion insurance fund that covers the insured portion, and a zero-balance orderly liquidation fund that covers the rest in theory, and a discretionary Treasury lending decision that covers it in practice. Here is the final synthesis that connects the bail-in blueprint, the FDIC illusion, and the uninsured deposit bomb into a single actionable framework. The deposit protection system in America has 3 layers. The first layer is FDIC insurance for deposits below $250,000 per ownership category per institution. This layer is real, has never failed since 1933, is backed by the full faith and credit of the United States government through the Treasury Borrowing Authority, and protects every ordinary household that understands and uses it correctly. The second layer is the systemic risk exception, which the Treasury Secretary, FDIC, and Federal Reserve can invoke to protect depositors above the insured limit when they determine that failing to do so would produce serious adverse effects on economic conditions or financial stability. This layer protected all SVB and signature depositors in 2023. It is real but discretionary, case by case, and not guaranteed for every future failure of every institution. The third layer is the Orderly Liquidation Authority under Title II of Dodd-Frank, which provides the legal framework for resolving systemically important institutions by imposing losses on shareholders and unsecured creditors rather than taxpayers. This layer has never been used. The Orderly Liquidation Fund has a zero balance. Its use would require Treasury borrowing and visible taxpayer exposure that regulators have so far avoided by using the systemic risk exception instead. The question for every person who has deposits above the FDIC insured limit, every business with operating cash concentrated at a single institution, and every household that has never performed the FDIC coverage audit described in the 1929 protocol video in this series is simple. Which layer are you counting on? If your answer is layer 1, the FDIC insurance and all of your deposits are below the insured limit properly structured across ownership categories, your protection is as solid as the full faith and credit of the United States government. If your answer is layer 2, the systemic risk exception will protect you if your institution fails. You're counting on a discretionary decision that has been made once but is not guaranteed to be made again. And if your answer is layer 3, the Orderly Liquidation Authority will ensure an orderly resolution that protects depositors above the limit, You are counting on a mechanism that has never been used, whose fund has $0 in it, and whose application remains entirely theoretical. The three layers exist in law. Only one of them has a funded, operational, historically proven track record. That is the layer you want to be inside. 3 steps to get there. The FDIC coverage audit at ED, FDIC, Gov, the institutional type diversification across a bank, a credit union, and Treasury Direct, governance, and the 30 to 60-day liquidity bridge at a secondary institution. 3 steps, available now, free, legal. The deposit protection framework is real within its boundaries. Understanding those boundaries precisely is the most valuable financial education available to any American household in April 2026. Subscribe right now, turn on every notification. And share this with anyone who believes their bank deposits are fully protected without having ever read the full text of what fully means. Let me go deeper on the FDIC OIG's own audit findings about the Orderly Liquidation Authority's readiness, because what the FDIC's Inspector General found when it evaluated the OLA program is the most damning primary source evidence that the third layer of deposit protection is not operational in any meaningful sense. The FDIC's Office of Inspector General published an evaluation of the FDIC's Orderly Liquidation Authority program in September 2023. The findings were specific and alarming. First, the FDIC had not completed operational level policies and procedures for executing an OLA resolution. Second, the FDIC had not identified how it would need to adjust its policies for an OLA resolution of different types of systemically important financial companies beyond the bank holding company structure. Third, the FDIC had not developed 2 regulations that the Dodd-Frank Act explicitly required. Fourth, the FDIC had not fully defined governance and individual practitioner level roles and responsibilities for executing an OLA resolution. And fifth, the FDIC needed to obtain additional staff resources to plan for and execute an OLA resolution. The Inspector General's conclusion was direct. Absent a consistent focus and fully established key elements for executing the OLA, the FDIC may not be able to readily meet the OLA requirements for every type of systemically important financial company it might be required to resolve. If the FDIC were unable to resolve a systemically important financial company, the banking sector and the stability of the U.S. and global financial systems could be severely affected. That is not a fringe analysis. That is the FDIC's own Inspector General saying in 2023 that the backup resolution mechanism for the largest and most complex financial institutions in America may not be executable when it is needed. And the 17 recommendations that came out of that audit have not been publicly confirmed as fully implemented. The Orderly Liquidation Fund still has a 0 balance as of today. The bail-in blueprint exists in law. Its execution infrastructure is incomplete by the FDIC's own internal audit. And the scenario in which it would need to be used, a systemically important financial institution failure in a stagflationary banking stress environment with the FDIC fund at 1.42% and the OLF at 0, is the scenario that the Federal Reserve Board's own published research documents as a genuine risk in 2026. That is the complete picture of the third layer, not a law that doesn't exist. A law that exists, has never been used, has an unfunded fund, and has an incomplete operational execution infrastructure, according to the FDIC's own Inspector General. The deposit protection system works within its first layer. Outside the first layer, the framework is less certain, less tested, and less ready than most Americans who believe they are protected have any reason to know. Now let me give you the specific calculation that shows who actually holds the $7.5 trillion in uninsured deposits, because it is not who most people assume. The assumption is that uninsured deposits belong exclusively to wealthy individuals who made a deliberate choice to hold excess balances above the FDIC limit. That assumption is partly true and largely incomplete. According to Bank Policy Institute analysis, the uninsured deposit population has 3 distinct components. First, large institutional depositors such as corporations, municipalities, pension funds, and investment firms that maintain operating accounts, payroll accounts, and settlement accounts at single institutions that routinely carry balances well above $250,000. Second, small and medium-sized business owners who maintain their business operating cash at a single institution for relationship and convenience reasons without having been told or choosing to structure the accounts across multiple institutions to maximize coverage. And third, individual households that have recently received large one-time deposits from home sales, inheritance, pension distributions, or legal settlements, and have not yet redistributed those funds into a properly structured, multi-institution, multi-ownership category deposit architecture. The first category is sophisticated and generally aware of the uninsured exposure. The third category is temporarily uninsured and typically moves funds within months. The second category is the most persistently vulnerable. Small and medium-sized business owners with $300,000 to $500,000 in a single business checking account, which is a completely normal operating balance for a business with annual revenues between $3 and $10 million, are chronically uninsured without necessarily understanding the full implication. When SVB failed in 2023, the most severely affected depositors were not wealthy individuals. They were venture-backed startups with operating accounts that carried uninsured balances because they had concentrated their banking relationship at a single institution. Roku alone had $487 million in deposits at SVB. Roblox had similar scale exposure. Those were not small businesses, but the pattern they represent, concentration of operating cash at a single institution without structuring for coverage maximization, is the same pattern that hundreds of thousands of smaller businesses follow every day without thinking about it. The systemic risk exception protected Roku and Roblox in March 2023. It may not protect the small manufacturer in Ohio with $400,000 in a single business checking account at a community bank that fails in the second half of 2026, if the Treasury Secretary's judgment about systemic risk does not extend to that institution. Subscribe right now, turn on every notification, and apply the three-step deposit architecture described in the 1929 protocol video to your specific situation, before the question of which layer protects you becomes one that the data environment is forcing. Let me close with a dimension that ties this video directly to the banking stress trajectory documented across this entire series, because the deposit protection question is not abstract in April 2026. It is connected to specific institutions and specific stress signals that are visible in the data right now. The Federal Reserve Board's published research from February 20 to 26 confirmed that in a stagflation funding shock scenario, bank profitability and capital ratios are materially reduced for a significant subset of institutions. The commercial real estate maturity wall of $1.5 trillion in loans scheduled to mature in 2025 and 2026 contains what Wharton researchers estimate is latent distress approximately 4 times larger than official delinquency data shows. The FHA delinquency rate at 11.52% is the historical leading indicator that precedes conventional mortgage stress by 6 to 9 quarters. The FDIC recorded the first bank failure of 2026 in February, when Metropolitan Capital Bank failed. The New York Fed's repo facility executed its largest single-day operation in over 2 decades in October and followed it with its largest year-end operation since the pre-pandemic period in December. And the stagflation environment produced by the Iran war, with consumer inflation expectations at 4.8% and the Federal Reserve policy trap preventing rate relief, is the precise economic configuration that the Fed's own research describes as the most damaging to banking system capital ratios and profitability. Each of those data points exists independently. Each one is a documented, primary source verified signal. Together, they describe a banking system that is moving along the stress trajectory described in this video, from stage 2 stress accumulation toward stage 3 confidence shock. In a policy environment where the tools available to the Federal Reserve to resolve a stage 3 event are more constrained than in any previous banking stress period in the post-FDIC era, the deposit protection framework is real within its first layer. The question of whether the second and third layers function as described when genuinely tested is a question that no one can answer with certainty in advance. The answer depends on the scale of the stress, the specific institutions affected, the judgment of the officials making discretionary decisions under maximum pressure, and the adequacy of the operational infrastructure that the FDIC's own Inspector General found to be incomplete in 2023. That uncertainty is not a reason to panic. It is a reason to act. The first layer of protection is real, available, and free to maximize through the FDIC coverage audit, the institutional type diversification across a bank, a credit union, and direct government obligations through Treasury Direct. Gov is available today. The 30 to 60-day liquidity bridge at a secondary institution is achievable for any household or business with the information and the 30 minutes required to open a second account and fund it to the appropriate level. Those 3 actions convert a household from one that is counting on the discretionary third layer to one that is firmly inside the first layer. That is the difference between hoping the system works as described and knowing your specific deposits are protected by the mechanism that has worked every single time since 1933. Subscribe, every notification, and protect what you have built by understanding the system that is designed to protect it, all of it, not just the comfortable summary. Here is one additional piece of context that belongs in this analysis because it is the piece that most people never find when they research this topic independently. The FDIC's reserve ratio target is 2% of all insured deposits. The current ratio is 1.42%. That gap from 1.42 to 2% represents approximately $8 billion of additional fund capital that the FDIC would need to reach its own target. The FDIC gets to that target through ongoing assessment income from banks, which is expected to continue building the fund gradually over the next several years under normal banking conditions. The problem is that normal banking conditions in 2026 are not the baseline. The FHA delinquency rate, the commercial real estate maturity wall, the repo market stress signals, and the Federal Reserve's published stagflation research all point toward a banking environment that is more stressed than the normal baseline against which the fund's adequacy was calibrated. When the fund paid $23 billion to cover the SVB, Signature Bank, and First Republic resolutions in 2023, it drew down the fund significantly from what would have been its normal accumulation path. The fund has been rebuilding through special assessments on larger banks since then, but it is rebuilding from a lower base in an environment with more stress toward a target it has not yet reached. That is not a description of an imminent FDIC insolvency. It is a description of a fund whose buffer is thinner than its own target in a stress environment that is more severe than its calibration assumes. The difference between 1.42% and 2.0% is not catastrophic in isolation. In combination with a zero-balance orderly liquidation fund, an incomplete OLA operational infrastructure per the FDIC's own Inspector General, a stagflation environment that the Fed's research identifies as damaging to banking system capital ratios, and a repo market showing the most elevated stress signals since the pre-pandemic period, it is a system with thinner buffers than it has had at any point in recent memory, facing a stress trajectory that is more severe than any recent period. That is the complete picture. Layers 1, 2, and 3, what each one covers, what each one does not cover, where each one's limitations lie, and what 3 practical actions move you firmly inside the layer that has worked every single time since 1933. This channel is the place where the complete picture is assembled from primary source data every week. Subscribe. Every notification. Be here. One final number that belongs at the end of this video because it is the number that most directly answers the question in the original title of this series. The question was, how many Americans are at risk of losing their bank deposits? The accurate answer, grounded entirely in verified primary source data, is this. The number of Americans whose deposits are fully protected by FDIC insurance, properly structured below $250,000 per ownership category per institution, is approximately 300 million, meaning essentially every ordinary household in the country. The FDIC has protected every such depositor in every bank failure since 1933 without a single exception. That protection is real. The number of Americans whose deposits are at least partially uninsured, either because they hold balances above the insured limit at a single institution, or because their accounts are not correctly structured across ownership categories to maximize coverage, is harder to estimate precisely because the data tracks dollars rather than people. But the 45% of total domestic deposits that are uninsured by dollar value represents a significant number of businesses, institutions, and individuals who are relying on the second and third layers of protection described in this video. The second layer is a discretionary systemic risk exception that has been used once. The third layer has an incomplete execution infrastructure and a zero balance fund. The practical action that converts anyone in the uninsured population into the insured population takes 30 minutes and costs nothing. The FDIC's coverage estimator is at ED. FDIC. Gov. Use it. And subscribe to this channel so that every development in the banking stress trajectory that makes this analysis more or less urgent arrives in your feed before it arrives in the headline. The deposit trap is only a trap if you don't know where the edges are. Now you know. Subscribe. The edges are exactly where they have always been. $250,000 per ownership category per institution. Everything inside that boundary is protected. Everything outside it depends on judgment calls, zero balance funds, and incomplete operational infrastructure. Know your boundary, stay inside it, and be here every week.